This is the IBJ podcast for the week of February the 2nd, 2026, brought to you by Taft. I'm your host, Mason King. Welcome back to the podcast, everybody. According to the latest figures from the federal government, the U.S. economy is chugging along at a strong clip. Unemployment is well under control. The prices of consumer goods are increasing at a fairly typical rate, and interest rates for mortgages are steadily dropping. On top of that, the stock market is regularly hitting all-time highs. What's there to worry about? Well, the Consumer Confidence Index, which is used to measure how consumers feel about their expected financial situation, is at its lowest point since 2014. And specifically, Americans' short-term expectations for their income, business conditions, and the job market have fallen well below the marker that could signal a recession. The misalignment of the big picture numbers and how consumers feel might indicate that not everyone is benefiting from the positive economic indicators. Throw on top of that the amount of anxiety Americans feel about our polarized political system, a recent wave of five-figure layoffs at large American companies, and the likelihood of a bear market after several years of outsized stock market growth, and you can appreciate any undercurrent of pessimism. On this week's edition of the podcast, Peter Dunn, aka Pete the Planner, and I discuss the role that our feelings can play in our financial decisions, even when we're presented with cold, hard data. And to that point, we discuss the return of the vibe session, a term describing the disconnect between positive economic indicators and the public's negative perception of the economy and how they're doing. Fear can inspire some people to eliminate all risk in their investments, which isn't necessarily a good idea. And we discuss how some Americans don't benefit from positive economic trends in the same ways others do. Here's our conversation.
It's my pleasure, as always, to welcome back to the podcast Peter Dunn, a.k.a. Pete the Planner. Pete, thanks for making time today.
Let's do it. How are you?
I will take this opportunity to ask you, as is now customary in Indiana, whether you are keeping warm.
Oh, yeah, you do have to ask. No. Here's the other thing. I was in Chicago this week, and it's actually technically less cold there, or warmer, as some would say, yet the wind cuts through you more there. I don't know how that works, but I'm freezing. Thank you for asking. As a bald man, I'm really freezing from the head down.
Yeah. When you were in Chicago, what were you wearing on your head?
That's the air in my ways. Nothing.
Mm-hmm. Yeah. Oh, well, you'll know better for later.
Sure.
So today we're going to talk about feelings and financial decisions. So on good days, we say investing strategy gives you a logical framework for making decisions. On bad days, people make truly terrible decisions about their investments based on their feelings. Does that make sense?
It does. I don't know where you're going with this, but this extends to daily finance and personal finance beyond investing too. Like, most people feel better on payday as opposed to the day before payday. Your feelings are impacted by that.
Sure. Another way to say it is our short-term feelings often dictate our long-term financial decisions and the way we judge our financial health and the health of the economy.
Yeah, sometimes when there's a temporary period of malaise or some negative feeling financially, a person will do a permanent act. They will overcorrect, and that's what you want people to avoid.
Yeah. It's funny what you said about payday. I mean, I don't get a paycheck anymore. I just get a little email notification that somebody has signed my paycheck. And I always get like a dopamine hit thinking, I did it. I did it for another 2 weeks. I somehow am employed.
Yeah, it is nice to know you're getting paid.
Yeah, I agree. So let me give you an example. Now, later in the interview, we're going to talk about the return of the vibe session, which we've talked about a little bit in the past. But first, I want to talk about a creeping fear based on vibes, but also on historical data that we need to be ready for a bear market. Okay.
Is this you or who's it?
This is people. It's me.
It's like your euchre group. Yeah. Well, who is that? Like, it's you. It's just like, I just want to be intellectually honest. Who is this? Is it you?
It is me, but it is also people on the internet. I can't believe I just said that. People I know who exist independently of the internet, for sure. But also, I read a lot of financial news based on investing, and I know that as is common, I think a lot of the time, there's a measure of good news, and then there's the measure of people interpreting the news as bad news.
This is interesting because I'm curious if there's a lot to unpack here. Thank goodness we've got a podcast. What's it based on? Like, start to unravel it for me a bit.
I am, and I'm going to give you a story. This is
good.
A monologue, unfortunately, because I do like to talk. So here's my example of how your frame of mind can change. Okay, this is my example. So I had a completely terrible weekend. I've been feeling a lot of stress at work. I was super tired on Friday, but because I knew my son really wanted to do this, we drove up to Pokagon State Park on Friday night.
Toboggan.
For the toboggan, right?
Yeah.
For the toboggan, yeah. Church retreat. This is something we do every year. Kids have fun as a toboggan. Saturday, I turn on the TV while I'm resting in bed, and we all know what I see. The way that I interpreted these events in Minneapolis were as a physical manifestation of everything that worries me about the future of the United States. Then it becomes clear the winter superstorm is coming. So we decide to come back to Indy on Saturday night. About halfway home, basically in the middle of nowhere, my car starts to lose power. It's sputtering. We're in trouble. We're able to get to an exit that had a motel. It was not the Huggy Bear Motel. It was the one across the street from the Huggy Bear Motel.
I know exactly where you were.
Yeah. So we proceed to spend 36 hours marooned at the hotel in a blizzard while we waited until Monday morning so the roads could be plowed and we could get the car towed to a mechanic. Meanwhile, I have things I need to do for work, but I don't have my computer. So I use my wife's computer, which is a PC and is inherently evil. Now I am in a permanent panic attack. It is unyielding. We finally get to the mechanic. We catch a ride home with some friends. Then we have 3 days of pandemic style working from home and synchronous learning from home. Somewhere in the middle of all this, I've just about lost it. And I decide, look, I'm going to pull all my retirement savings into the least risky option in our 401k plan.
Really?
Intellectually, yeah, I think the world is coming to an end, essentially. My emotions have taken over. Intellectually, I know this is a bad idea. I can tell myself that this is a bad idea. But from an emotional standpoint, I am looking for relief. I think this will make me feel better. Now, let's say that I decided to call you and said, Pete, this is what I'm thinking. Don't look so surprised. What would you have told me?
I mean, I got to back up a little bit here. There's a few things that everyone listening is thinking. When you said in 36, we all thought you were going to say dollars. We thought your hotel room cost $36 across from the Huggy Bear Motel. Like, that's where most people were thinking. And instead of hours, $36. The second thing is, clearly, you need to take some magnesium for sleep, man. You need to de-stress, get on that Neasy. It'll help you quite a bit. I've
never heard that before. Magnesium is good for sleep?
Oh, just go down the rabbit hole, brother. Anyway, yeah, it's funny. I've seen people spiral for all sorts of reasons, but that was an epically terrible few days for you. I'm sorry you went through that. And so it isn't surprising that you came out that the other end of that. I mean, with the true manifestation of our country's challenges in front of our face on Saturday to, I got to do something about this. I got to do something, whether it's cathartic or I got to feel like I'm progressing. And so you say, well, I'm going to protect my money for when this whole thing goes down. That's not unusual. I would say there was a lot of feelings this weekend. You're the first person that I've talked to that it made its way into your feelings about the capital markets. But yeah, I understand.
Okay. Now, what would you have told me?
Have your goals changed is the very first thing I would say. Have your financial goals changed from pre-tobogganing to post tobogganing? Did you hit your head tobogganing that then changed your financial goals?
I guess that emotionally, my financial goals changed to I just want to feel better.
I mean,
but logically, numerically, no, the math didn't change.
Yeah, then I wouldn't do anything. Like I think you start there. Now, I do want to acknowledge the fact that you said you have worries about the future of our country, and I don't want to like completely, dismiss that or talk past it. If that truly is the case, and you talk about our country and you talk about stability, see the prices of gold continue to rise, and you see these little signs of like, okay, well, maybe there's something to that, then maybe that you may need some protection within your portfolio, but that doesn't mean go to cash per se. I think you could find protection without selling everything, because
We're going to get to that here in a second. Okay.
Yeah.
Let's, for the folks who don't understand why it's a bad idea, or why conventional wisdom says it's a bad idea to take your money out of the stock market when you feel like we're hitting a rough patch. Why is that a bad idea?
because you don't know when to get back in, right? You can't actually accomplish your retirement goals. I want to say that again. I want to say it loud for the people in the back. You cannot accomplish your retirement goals without the markets. You can't sit out of them. So I'll let someone else leave a note in the comments about how you can, and just don't click on their link. Therefore, you don't know when to get back in, and you'll get back in when it's too late, and the gains or the comeback story is already happening, and you will have literally lost money. Like, so that's the weird part. You sell to protect yourself. The market drops, and you're like, I did great there. And then you're like, well, I'm going to see if it's safe. By the time you pull the trigger again, you miss, and we're better off never leaving the market. And that happens a majority of the time, a vast majority of the time.
Now, beyond the feeling that I have that we could be on the way to some catastrophic event, there's some historical data to consider. The S&P 500 has enjoyed 3 incredible years of double-digit growth. It has been exceedingly rare over the last 100 plus years that the stock market has 4 consecutive years of growth. In addition, markets tend not to do very well during midterm years and presidencies. Should those 2 facts change my investment strategy at all?
I mean, are you going to go to Super Bowl winners next? Is that are you setting me up for that?
I forgot about that. Do we have any wisdom on Super Bowl?
Oh, yeah, I will have to look. I don't know, man. The first thing you mentioned, certainly a pattern, right? Is it informative? I don't know. I think it's like you're standing over the roulette table and you're like, I landed on black 4 times in a row. It's got to be red. I don't think, even though that is my strategy, I don't think that's how you're supposed to do it. Now, the other element of midterm elections, probably a little bit more to it there, because that can impact policy and communication and those other things. Other than that, it's just time passing. I do buy to the idea that we've more or less been in a massive bull market run for, feels like decades. I mean, it's not been decades, but
it has not been decades.
2009, there's been little blips, but we've been mostly directionally heading north since 2009. And at some point in time, it's going to stop doing that. But here's the thing, dude. When we do correct, or we do go into a bear market, is it a blip? Is it a decade of darkness? Like, what is it? Because my personal belief, don't let this impact anyone's investing, please, is that when we do have that off year, which is going to be brutal, and we're all taking the shorts, then it ends up being a blip. Even if it's let's say you're down 30%, next year you're down 6%. It's the timing of trying to get in and out of that hurts you when the market inevitably has a massive recovery. But I think if we're being cognizant of feelings here, it's all the geopolitical stuff that is happening during those time periods that makes it feel even more out of control and theoretically hopeless, depending on your perspective.
Yeah. I think back to the tariff turmoil, I think I used in a headline. I don't know, it was early past year when the markets really didn't like the initial salvos of tariffs coming out of the White House. And I think, will we lose like 10% maybe? And that was, you certainly had your share of people who are saying, this is going to sink the whole ship. And I resisted doing anything about it. And I was super happy when at the end of the year, we ended up 16%. So thankfully, I have that example just to pull out of my pocket when I feel this way.
Yeah, I maybe we're going here today, maybe we're not, but we are now. You look at those tariff threats and then implementations and like they definitely caused market reaction, which then had President Trump pivoting in strategy. But then in the last month, we've seen two separate reports come out that shed a completely different light on this. One of them that something to the tune of either 94 or 96% of the impact of tariffs have been predictably stomached by consumers as opposed to manufacturers. And then today you saw that the trade imbalance for the last, I believe, November or December.
Yeah, it was November. Yeah,
it was November. Had a significant trade imbalance, significant increase, meaning that we were upside down on that. October was theoretically a good month. So that is to say, like, the theory behind tariffs to deal with the trade imbalance and to lower the trade imbalance had the complete opposite effect than what was intended in November. So you have the market feelings and you have the predictions, but now you're having this real data come in to say not only is it making things more expensive, but it's not even solving the trade imbalance, which was one of the principal reasons to do it.
Okay, let's take a quick break so we can hear from our sponsor. This is the IBJ Podcast.
Taft, today's modern law firm. At Taft, we cultivate a highly respectful, transparent workplace that fosters creativity, teamwork, inclusion, and diversity. We couple our culture with a client-first approach, rewarding lawyers who understand their clients' goals and work to deliver success. Taft, the modern law firm. To learn more, visit taftlaw.com.
Spring is coming, and that means it's time to bring your backyard back to life. At Indie Grills, we design and build custom outdoor living spaces that turn your patio into the best room of the house. From stamped concrete patios to cozy outdoor fireplaces to fully custom outdoor kitchens built for grilling, gathering, and entertaining, we do it all. We handle everything from design to build, and we're known for doing it one way. Built fast, built right, on time, and on budget. So before summer fills up, start now. Visit IndieGrills.com and schedule your outdoor living consultation today. Indie Grills. This is where spring begins.
All right, we're back with this week's edition of the IBJ Podcast and my conversation with Pete the Planner about the ways our short-term feelings often dictate our long-term financial decisions and the way we judge our financial health.
I want to go back to something that you said before. Now, let's say that I'm still not convinced. I feel like I need to do something to hedge against the effects of a possible bear market, besides just letting everything ride. What are my options to, as I maybe not flee to safety, but as I slowly saunter to safety?
You think the verb's the thing?
Of course it is.
Why don't you just toboggan to safety? I mean, while we're at it.
Maybe a little bit too fast. Those things get up to like 35 miles an hour.
I've never done it.
Yeah. It's cold, dude.
Oh, I believe you. So, okay. I'll answer your question, sir. But I need some help here, because when you say a bear market, do you mean an extended bear market, or do you just mean a correction of more than 20%? Like, what do you, like, help me, because they're two different answers. Like, do you think we're going to go through an extended period of the market losing value, or you think we're going to go through a punch in the face that knocks you down? Like, what do we?
I think we're going to go, let's say that I suspect we're going to go through an extended period. Recession.
Yeah. So typically and this is data from 2020, so I don't know if it's updated, but when we go into a bear market, it typically takes 4.2 years to recover from that bear market. So whatever you think the end of this hypothetical bear market would be, you would be made, air quotes, whole in 4.2 years. Okay. So that's the first data point where I'd go, okay, I think a recession is on the horizon. Therefore, I'm going to pull my money out. So a quick question back to you then. The new investments that you make out of your 401k or into your 401k, I should say, out of your paycheck, would you put those into cash or would you put those into the market since you'll be buying into a declining market, which is what you want to actually do?
I know what you're saying. I think that I would want to continue to put my 401k match for what it is and the considerable amount of money that I'm taking from my pay that goes into the 401k. I would want to continue to do that because
Put it in the market.
Continue to put it in the market because I know that in the end, the recession just means stocks are for sale. However, I want to blunt the effect of the recession of the bear market on my already existing investments. Like, for example, they always say, make sure you're diversified. What would a security, what would diversification mean if I was really trying to protect my current investments?
Okay. Yeah. So lots of paths here. Can I trying to do the best I can of giving specific advice to you. And the reality is, I think you are representative of a lot of other people's situations. So it's not going to be so wildly specific that it doesn't apply to others. But time horizon, can you help me there of like, when do you believe all of this giant nest egg, so big it won't even fit in a nest? When do you believe you'll start poaching that thing?
Okay, we've got kind of a bifurcated strategy because I'm 10 years older than my wife.
Whoa! Oh, sorry. Go ahead.
Yeah.
All right. I don't.
So one of us is going to retire in 10 years. The other is going to retire in 20 years. So if we just look at my investments, I'm looking at 10 years. Though I expect to live a very long life. So it's not like I'm just going to cash out.
I love that your street cred just went up so much by saying your wife's 10 years younger than you. I love listeners are like, wow.
How about that?
I apologize. I didn't understand your game. All right. So if that's the case, even if we're entering a bear market of 2 years, it is my opinion that you would be made whole by the time you need the money. But the other way to soiree, I don't know what you said, head over to a safer place is just to make sure that your asset mix is a little smarter. I don't know if you're 80-20 or 90-10 or 70-30, I don't know what you're at, but you could start to change the mix a little bit between equities and bonds, or even start to go to alternative asset classes, whether it be sort of real estate style investments or so currency or alternative investments, those sorts of things. So yeah, I mean, you've got things you could absolutely do. Do you have a sense of your mix? Do you know?
Well, see, I'm in a target fund.
Okay. And you're in a target fund that is is it like a 2035 fund?
I'm in 2 different target funds because I couldn't make up my
dude.
mind. I'm in 2035 and 2040.
Okay. Don't be in 2 target date funds.
Okay.
It defeats the purpose of having a target date fund. Anyway.
So which one should I use?
I'm guessing, well, if you're more conservative, probably the 2035. If you're feeling a little saucier, which you're not, because we're talking about toboggans and sashaying and the Huggy Bear Motel, probably the 2035. I think you're probably, I don't know, that's a really good question. Let me see what
I could go to, the 401k vendor that we have.
Yeah.
And say, well, hey, we have a bunch of different funds here. We could have, a bond fund for you. We could have some sort of bond index fund. All kinds of different levels of risk. If I just did that, if I just moved some money over towards that end, I mean, is that considered diversifying? Is that going to make me safer?
Kind of. Okay, so I still did a little chatting here. Your likely asset mix is 60-40 right now.
Yeah.
So you don't have massive exposure to the market. Like, I'm a much younger man than you. I'm closer to the age of your wife. And I'm like 90-10, right? So like I am exposed that way. I think you have less exposure either than or than you just think about on a regular basis. Because here's the thing: when you see scary market news, no one goes, "Well, how many bonds do I have?" Like no one like tries to lessen it with bond exposure. You go, oh well, here's the thing: I'm at 42% bonds, so I'm fine. Like no one does that. I don't know. I'm not trying to talk you out of protecting your position. I'll just say, from what you've shared, you're pretty well protected. Now, let's do the 2040 fund and see what we think that mix is, just as a little comparison. Answer is, using gallons of water in the rainforest, more likely 75-25. Okay, so that would give you a little bit more concern, to your point.
Do you know what? This is when I decided, maybe I should be in the 2040. So I took a look at like the annualized returns.
Of course.
Of the 2035 and the 2040. The difference is 1%.
Yeah, that's not.
It's like difference between 8 and 9%.
Well, I mean, I just said it's not worth it. There's also not true. Every financial advisor just spit out their matcha. 1% over time on 1% a year over time is a significant difference.
Oh, good.
However, this is where risk tolerance comes in, and this is where sensibility. I'm not going to get into gut feelings. We're not going to go there, but I'll just say, like, if you are a little more conservative than 75-25, then 60-40 is a reasonable thing to do. But you also did something that most people do. I don't know if you know that most people do this. Most people look at the annualized returns, and then that's how they choose what they're going to invest in. Most people do that. It really should be matched up with when you need your nest egg.
But I don't need the whole nest egg all at once. I'm just going to start.
But they take that into account too within the glide path. Like, for instance, this is not an ad. I use the Indiana 529 plan for my kids. My daughter is a junior in high school. She knows everything, by the way, apparently. Junior in high school. So the glide path of that age-based fund is invested in a way that no matter what happens in the economy in the next 18 months, which could brutalize her fund, it takes that into account. And that's why I have comfort around it. Now, my own risk tolerance is that of, I'm good with being in the domestic or international equities market. But if I applied that same thinking to the fund that she needed in 18 months, I'd be a bigger moron than most people think.
Okay. Let me tell you something. Maybe you didn't know this about me. I love cash. Nothing makes me happier than to look at my investment account and see how much cash is in my investment account.
Can we talk about this? So you like cash. Okay, so you're looking at your statement and
you're running off a bunch of cash from investments, and I'm like, wow, I've got 5 figures here in cash.
Okay. Wow. Okay. So if you're looking at your investment statement, you're looking at the cash.
Yes, because it's the thing that makes me feel the best.
I'm not here to judge you.
Go ahead.
I don't even know what to say. I've never heard anyone say that to me.
Yeah. I feel great about having cash. It's the emergency fund.
But is it your retirement account or just like your brokerage accounts?
My brokerage accounts.
Okay.
Sorry. Yeah.
Okay. Said through that lens, I'll look at the cash balance within my brokerage accounts, but I'm more interested in what the variability of the invested money is doing than the cash. I think you're more conservative after having talked to you for years and letting people listen to this conversation. I think you're more conservative than you think you are. Financially, of course.
Right. But this is my feeling. I'm worried about the catastrophic events because I'm a catastrophizer. I want to have, let's say that right now I have 6 months.
To live?
6 months.
Oh.
I have 6 months.
Now it's like, you look fine.
I have expenses. I have an emergency fund that has 6 months of expenses. Let's say that, I really want 12 now. I want to double it.
Okay. Well, I think you should double it by the time you retire.
Right.
But I think if that's a 10-year period and you do your own math, you just have to add a little bit a year. It's a math equation. You can figure out to double it how much you need to contribute. But the question I ask you is, are you going to do that with your income? Or are you talking about a balance sheet transfer where you take money out of the market and turn it into cash?
Well, that's my question. Is that if I wanted to double it like right now, what's the smartest way to do it?
Jeez. Oh boy. So this actually would be getting into giving you securities advice. So I just want to have another disclaimer there. I can't tell you, what you should do is to sell your investments and go to cash. That is securities advice. Based on your feelings about the world and socioeconomic climate, that is the reason for that?
Yes. All of them. Everything that we talked about to this point. Yes.
Okay. Let's go down this path for a second. At the beginning of the pandemic, the very beginning, when we're all just like, what? Did you think about this sort of stuff? And did you actually have physical cash more than normal on hand?
At that point, I already did. But physical cash, like in my wallet?
No, but just like at home, in your sock drawer, fat stacks.
If you want to think about it as like money in our savings account and that gets terrible interest, yes, we had a pretty significant amount of money in savings already.
Okay, well, see, here's where I'm going with this. I am a pretty level-headed person around these things, you would hope, or otherwise I've just got the greatest finagling of an entire population, but pretty level-headed around these things. When the pandemic started, I had an inordinate amount of paper cash at my home because I didn't know what in the heck was going on. I didn't know if there was going to be a run on banks. I did not know. By the way, I have none of it left, everybody.
Where'd it go?
I bet on the Colts to go to the Super Bowl this year. No, I redeposited it once everything calmed down.
Okay.
And so I asked that because what I'm trying to get at is if you really feel, if it's a personal feeling of yours that we're headed towards some catastrophic whatever, I'll let you name that later. How long of a period does that last? Does it last 6 months? Does it last 6 months in which you couldn't gain access to your other money by selling investments after that 6 months? Or do you literally need 12 months worth of money because you couldn't get to your other money within that 12-month period for a secondary backup plan? That's where a person can spiral real quick and say, I have a lot of fear, and so I'm going to satisfy this fear with a more permanent solution than I should. And I think that's the tree you're barking up right now.
Okay. Yeah, I guess.
Yeah.
In the catastrophe that I imagine, we're talking like 2000, at least Great Recession, like 40 to 50% drop in equity value, and that you don't pull out of. You're not going to pull out of it for several years. And at that point, I'm really not going to want to try to take any more money out of my savings, provided money means anything. At that point, I just want to make sure that I have legal tender.
Well, dude, that goes back to my COVID thing. Like that goes back to me literally having a means of exchange by having paper cash. So are you there? Like, are you like, I don't know. I don't know how much you want to say one way or the other, but like, are you at legal tender language here? Because a person starts saying legal tender and it's a signal of real fear when you say the phrase legal tender.
Yeah, I guess so. You are for the potential. Yeah, for the potential that since all of our money is digital, that it could be compromised digitally in some way, that we would actually need to have legal tender. But then, of course, in the argument, if you extend the argument is, well, if all of our money, our digital money is compromised, what is paper money even going to be worth?
You had a rough weekend, brother.
Unfortunately, this is what it looks like inside of my head most of the time.
Yeah, I understand. I think all of us have some form of this. All right, I have data. This data is not good for you, bro. You're not going to like this.
Hit me.
S&P 500 peaked in September of 29, just right prior to the Great Depression. If you don't count dividends, it took 25 years to get back to its nominal price level.
I did know that, yeah.
Okay. If you include dividends, it's 15 to 16 years. And that's a really important distinction. The Great Depression included a 90% market decline. You previously, a few minutes ago, said a 50% decline, which is a lot, but it sure as heck ain't 90%.
Right.
And I mean, maybe it's the same thing in theory. I don't know. I always think about, personally, this is how I get my head around this. Like, as Peter Dunn, I go, all right, I think something bad's going to happen. how long will that bad exist? And am I comfortable with that period of time in the recovery it's going to take? That is literally how I think about it. If I go, oh, I think we're in trouble this year, but then after the midterms we'll be fine, I wouldn't even look at my statement. I wouldn't even open my statement. I think this conversation is more representative of seeing the impact of Americans not finding alignment with each other, right? And there's got to be some downstream impact of this on the people's lives that don't necessarily seem involved, right? Because it's so far, it's like, oh, that's happening over there. The closer it starts to feel like it's happening to all of us is when you start to say, how will this impact my health, my freedom, my money? And I think that's where you are. And to be honest with you, there are people that wildly disagree with you, as you might have read in the comments section of any of your posts. They might feel the exact same way, but for a wildly different reason.
Oh, for sure.
And I think that's the interesting part about this, because it actually aligns us.
Yeah. Here is I'm glad that you use the word alignment, because that kind of helps us get into vibe session. So if folks aren't familiar with the term, it was coined in 2022 by an economic analyst named Kyla Scanlon. It's not a formal economic indicator. The Fed doesn't measure it. There's no official index. It is a way to describe the disconnect or misalignment between what we see as relatively positive economic indicators and the public's negative perception of the economy and how they're personally doing. So the data could say the economy is doing great, but we as individuals could feel like we are in a recession due to any number of factors. It could be stagnant pay, rising cost of living would be a big one. I'm not super at peace with the term vibe because it makes it sound like you're just imagining things or that you're just kind of relying on your instincts.
Well, your wife's 10 years younger. She's comfortable with the term vibe. Just generational.
I know there's so many things I need to learn just language wise.
I'm with you on that though. Like I vibes is interesting, right? Like, yeah, it's all vibes.
There are many consumers who are struggling with paying basic living expenses and have found themselves stuck in an economic sense without a clear path to elevate their status. I mean, that's not vibes of them, that's real. But they feel the misalignment with news that, hey, everything's great.
Yeah, and then actually that almost pokes at you when you're on the other side of it, right? When you're not doing well and the wrong person says, I'm great. It's like, what? It actually makes you feel worse. I've been actually thinking about writing a column about the two economies, and not in this like political sense, but more of how does a person fight their way into the good economy?
Oh, that's great.
Because I'm in the good economy. Like I just am.
Mm-hmm.
There's negative impacts to my life and various aspects of my financial life based on the current economy. But if I'm being honest, I'm in the good economy. How does someone who is not find their way there? And it's not an attitude, I can tell you that, right? This isn't a pull yourself up by the bootstraps. Here's the best I can do, and I haven't written the column yet. May not. Who knows? Maybe you'll tell me it's the dumbest thing I've ever said, which would be a stretch because there's a lot I've said. I think you need your income to go up to the tune of 20% from what it's been at sort of a base level. And it needs to be sustained there for 3 to 5 years for a person to change their personal economy. Because if it is less than 20%, you're likely to have that be consumed via lifestyle creep or trying to repair some of the junk from the past, which doesn't get you out of the hole. It just gets you closer to the top of the hole. So you need a sustained period of time that is significant enough for you to not only get out of this bad economy hole you're in, but then to expose new assets to the good economy, which keeps you in the good economy. The reason you and I are theoretically in the good economy is because we have money invested. And so therefore we benefit from the last few years, and those who didn't have money in the market didn't.
Yes. I mean, that's what's the word? It's not a paradox, not the irony.
it's just a bifurcation of reality.
It's not hard to make a lot of money if you have a lot of money. If you don't have a lot of money, it is difficult to make money.
So there's the greatest probably personal finance book ever written. I'm trying to look at my office to see if it's in here. By the way, I didn't write it. George Clayson's The Richest Man in Babylon. The whole concept of the book is literally what you just said. Is the way to get a bunch of money is to have a bunch of money so that your money can work too. And if you're thinking about it in that really distilled sense of like, okay, Mason, you have an income and your income, so you are working and you earn an income for your work. If you have money, you have assets, those assets are also working and they gain an income, but that income is reinvested. And so if you think of it that way, just for one single human, forget marriage or partnering off with someone, you either have one incomes or two. And it's one income is if you're in the bad economy and two incomes if you're in the good economy. There's the column. There it is. Oh, good Lord. You have to edit it anyway. Comma problems.
All right. I'm gonna hit you with the good news.
Oh.
When we're talking about the misalignment between the news and how people feel. According to the Commerce Department, America's gross domestic product, which is the nation's output of goods and services, rose at a 4.4 annual pace in the third quarter of last year. I might be wrong here, but my understanding is that anything above 3% is considered very strong.
We talked about this on my podcast last week, this exact thing. I think we felt as the year went on, third and fourth quarter, that the economy was in a better spot than we all feared in the second quarter. Like second quarter felt like dark.
Yeah.
But I did not feel a 4.4% annualized pace. I definitely did not feel like that to me. So I'm not saying I doubt the number, but that is where the vibe session is very real. Of like, we're sitting here talking about the duality of a good economy versus a bad economy, and the whole darn thing's growing at 4.4% annualized. And that just even passed the sniff test to me.
Yeah. Consumer spending, which accounts for 70% of U.S. GDP, grew at a healthy 3.5% pace, according to the people who keep the numbers.
Did someone tell Nike that? Or did someone tell McDonald's that? Because if you look at their stocks and you look at their forecasts and their outlooks, I think they would take issue with that. That's where you start to look at the numbers and you're like, really? 3.5% increase on the 70% of the consumer economy towards GDP, and yet the value menus at fast casual restaurants are like all the rage. Really? 3.5%? I don't think so. But whatever. What do I know?
Okay, we'll get to that in a sec. Job market is a little bit trickier, although the job market has been lackluster recently and it can be difficult to find a new job. The unemployment rate, the government tells us, remains low at 4.4%. So I think what they're calling it now is a no hire, no fire labor market. Are you familiar with that term?
Yeah, man, I'll tell you, no one loves branding unemployment quite like those folks. There's the quiet quitting. There's a whole group of those things. 4.4%, right? That's what we're at.
Right.
Too? That's great. I mean, it's phenomenal. It's phenomenal unemployment. I will say this last 168 hours or so, pretty brutal for mass layoffs, though. I mean, we're approaching over 100,000 lost jobs for massive employers, and that feels a little scary going into the mid part of the first quarter. That's scary.
So we're in earnings season. We're getting reports for year-end earnings for a lot of major companies, and I don't know. It seems like this is typically a time when the companies say, "Hey, I think we're going to retrench here, and we're going to save some money, and we're going to lay off some people." It's just that the layoffs that a lot of them announced have been in the tens of thousands.
Yeah, that is this early in the year to see them. But those usually, I know it's always around earnings season, but I always feel like all those big job losses happen like post Thanksgiving into December. And there were some modest job losses, by the way. Anyone who loses a job, it's painful for them. But the announcements the last couple of days have been wild. UPS and Amazon, massive layoffs.
Now, let's look at the Consumer Price Index, which measures the average change in prices for commonly purchased goods and services like rent, groceries, clothing, fuel, education, recreation, medical care. So in December, the government reported that consumer prices rose 2.7% over the previous year.
It's great.
Which was about the same percentage for the year that led up to November. This isn't exactly the same thing as inflation, but it's really close. I know that the Fed's goal through its monetary policy making is to get inflation down to about 2%.
Yeah.
But I mean, isn't 2.8% within what we consider to be like a normal range?
That's what I use. 2.8 is what I've used my entire career to project sort of the assets or income at retirement.
Yeah, that's right. Actually, in your column this week,
Yeah.
I think you used 3% for inflation.
I think here's what's weird about that. And this is cynical. I think part of the misunderstanding here for the general public is just their own misunderstanding of like high school economics, of that when inflation goes down, that's not deflation. Like when inflation lessens, prices aren't getting cheaper. They're just getting less steep, slower.
Yeah.
Right. And I also mentioned on my podcast, I'm not plugging my podcast. I'm just trying to draw a reference point. By the way,
You mean the podcast that's on the IBJ Media Network of podcasts?
I don't even know. No, I'm just
Who are those guys?
I don't even know. Yes. I think the biggest issue with inflation right now is that President Trump said prices would come down, and that was a really unforced error by him, because it would have been virtually impossible for the entire market basket of goods to come down. Now, fuel is going to go up and down, right? So it is come down. Food ain't going down. Beef's not coming down for years. The beef is not coming down so like I think that's the biggest issue, is just like saying something that can't actually happen.
So that leads us to the Consumer Confidence Index. Consumer Confidence Index, based on a survey of consumers, used to measure what consumers are feeling about their expected financial situations. I guess the practical value of the index is that it allows us to assume that if consumers are optimistic, they're going to spend more money and stimulate the economy. If they're pessimistic, then their spending patterns could lead to an economic slowdown or recession. But in January, U.S. consumer confidence declined sharply, hitting the lowest level since 2014. I forget what was happening in 2014. And specifically, their short-term expectations for their income and business conditions and the job market fell to a level which isn't going to mean anything to anybody. 65.1. What's important is that is well below 80 points, which is the marker that can signal a recession. Hence my fears of a recession.
Yeah, it's legitimate. There was an article the other day that said people breaking home purchase commitments, like that. There's a term for it, backing out of how home purchases.
Oh, for real, that happened like in the house across the street from us.
Yeah, it's like
it was pending, and then like no one's touched it since.
It's wildly high right now.
Yeah,
it is happening. I don't want to say more than ever, because I don't know that to be true, but in inordinate amount of time compared to recent history. So I think that's a manifestation of a consumer confidence issue of like, this doesn't feel right, which is really strange because directionally mortgage rates have come down a bit. Obviously, with the Fed holding steady yesterday, they're not going to come down for the spring, but I don't know.
So when we were talking about two different economies, another way that people talk about this is a K-shaped economy. Do you have any feelings about that formulation?
Yeah, I think that goes back to I sort of dumbed it down even more of just saying that there's a good economy and a bad economy, right?
Yeah.
There is a scenario, if we go through recession, that everybody, it's usually called a K-shaped recovery, right? So something has gone wrong for all of us, not everyone, but most people. And then the good economy people recover, and the people that are stuck in the bad economy get worse.
Yeah, right. So it's the one arm of the K is going up, the other arm of the K is going down. Here's my question for you.
Yeah.
Do people in middle and lower classes have more exposure to inflation than people who are well off?
I love it.
You look unhappy.
Nah, it's just the lunch. I think I'm going to say yes, but the operative word here is more. I would say yes, but it's because that they've got less discretionary income. So it's not a matter of, I'm just going to save my money or I'm going to do this with it, therefore not exposing it to inflation. just so much of their income is in the consumer economy and is going paycheck to paycheck that I would say, yeah, they actually have more exposure. Now, the weird thing about that, Mason, is like, let's go back to beef prices for a second. Beef prices are insane. If you tried to buy some sort of piece of cow over the holiday to cut up with your family, we just lost PETA as a sponsor. You're like, what is going on? So in a K-shaped recovery, people in lower income situations are probably not going to be disposed to buy so much beef. So they're not exposed to that, but they're still exposed to all the other inflation that's going on.
Right.
I would say they're more exposed.
Right.
That's my opinion.
So when I'm somewhere there in the middle, but I can say that a lot of our expenditures are related to healthcare, housing, food, and childcare. And those are all things that are subject to inflation.
Yeah. I think this goes to optionality always. I think the more money you have, or the more discretionary income you have, or the more buffer, whatever, the more optionality you have. When you have fewer of those things, you are just trapped. You were just trapped in that reality. So things like childcare and those other elements, you're forced to deal with head on, because in a higher income household, someone might say, oh, well, we have two incomes. I'm just going to stay home and then not have to deal with childcare, and I just won't have an income. And that is a feasible solution for people at a certain income level.
If nothing else, this vibe session is a good example from my perspective of somebody who reads the news and reports the news. It's a good example of how inexact the business media's reporting on the economy can be, especially when, you're just reporting on the major economic indicators. It seems kind of foolish to, just take one economic indicator like GDP and generalize about, hey, things are good.
Yeah, individuals do that with credit scores, though, too. They'll be like, I've got a good credit score. My financial life is good. I'm like, And so there's no doubt people want this reductive number that makes you feel like you understand. But I look at inflation and unemployment. Those are the two that, if I'm trying to judge the economy, and GDP too. But what do you look at?
How much money is in my savings account?
Well, yeah. But that has nothing to do with the economy. That has to do with how prepared you are.
I know. I'm tired, and I'm hungry. And what's good about that is that I'm now temporarily not so worried about things. What's great about this is that I feel like after this conversation, I feel like I don't need to do anything different.
After this conversation, you do?
So I'm going to stay the course.
Great. Watch the market crash next week and you're going to sue me.
I know. I've been watching it here on my ticker. I think it's S&P's down 1%.
Again, 1%.
Doesn't that make you feel good?
Is nothing. None of what I said today is financial advice.
Right.
The only thing that I point to through the entire conversation that literally everyone needs to hear and think about and ask themselves is, when you start to feel this way, as we all inevitably do, and it's just a matter of whether it's bad or really, really, really bad, like staying where you stayed this weekend, did your goals change? That's it. That's the question. Because if you go, no, then you're fine. If you're like, actually, you know what? All of everything that went on this weekend made you want to change how long you want to work, what lifestyle you want to live, then dude, you should do something. But if it didn't change, then chill out.
Noted.
We did it.
All right, I'm going to go buy myself a treat. I'm going to go get a burrito.
Hey, at least you can get bed bugs this weekend.
My thanks again to Peter Dunn. And a quick reminder, his column on personal finance appears regularly in the print edition of IBJ, and you can find several years' worth of his work at ibj.com. And folks, now before you get on with the rest of your week, there are several stories in this week's edition of IBJ I want to draw to your attention. First up, since IUPUI split in 2024, Indiana University and Purdue University have dedicated hundreds of millions of dollars to their respective downtown campuses to grow programs and attract students. Mickey Shuey has a progress report. Also in this week's issue, Daniel Bradley explains how Indiana's hospitals are enduring financial challenges that threaten their ability to provide services. And Marek Mazurek breaks down how state lawmakers hope to ease regulations for home builders. And again, you can find these stories in the latest print edition of IBJ or online at ibj.com. Now, it is quite a bit easier to access all the latest local business news and all of IBJ's data on Central Indiana's business community and economy if you're a subscriber. We're running a promotion right now that gives you complete access for $1 per week for 3 months, just to get a sense of how valuable and original our content is. Just go to ibj.com and click on the subscribe button. And thanks again for making time this week for the IBJ podcast. I'm Mason King. Hang in there, everybody. We'll be back again next week.